Inflation and mortgage rates have a relationship. What is CPI and PPI are topics we're going to cover. Inflation and mortgage rates have a parasitic relationship. When inflation goes up, so do mortgage rates. And when inflation stabilizes, so do mortgage rates. So basically, inflation is bad for mortgage rates. Two major gauges of inflation are the CPI and the PPI. CPI is the Consumer Price Index. This gauges inflation for the everyman, the buyer of retail products. PPI is a Producer Price Index. This indicates inflation for the manufacturer. It gauges how much it costs the manufacturer to produce their products for the consumers to buy. Now keep in mind, if the manufacturer is taking too much of a hit due to inflation because of a high PPI, at some point they're going to pass down that pain to the consumer, which in turn negatively affects the CPI, which would be horrible for inflation and in turn mortgage rates. There's good news. Over the past few days, inflation is showing signs of finally cooling off, as reflected by both the CPI and PPI recent numbers that came in better than expected, echoing each other. As a result of better inflation numbers, we're seeing much better mortgage rates, and in turn, this gives buyers more purchasing power and is great for the economy. Now I have a question for you. Now that inflation is a bit better, do you think that retailers are going to pass along those savings to consumers by reducing their inflated prices? This is Mortgage Mo and just my opinions. Stay blessed and happy house hunting.